This video is sponsored by the award-winning Daily Market Movements trading platform. To open a live or demo account, simply visit dmmtradingplatform.com. Hello guys, it's Max here from Daily Market Movements. Welcome to another episode where today we're going to be analysing the Nasdaq100 futures chart. Just before I start today's video, anyone who's interested in joining my free analysis group over on Telegram, then please do not hesitate to scan this QR code on your screen. Let's start here by having a look at the Nasdaq100. What a day it was yesterday. You know, we ended the trading session down 3.5%, and this was due to a knee-jerk reaction that occurred in the market because we had that statement come out, that FOMC statement, which kind of showed us that the Fed was looking to slow down the rate that the interest rate hikes have been coming out the last 3 months, which of course is 0.75 basis points, which is a record amount to hike an interest rate in such a short period of time. Usually, just so that you know, it's around 0.25 basis points, but 0.75 basis points is just, it's 3 times the usual amount. So we got that in the statement. The market traded towards the upside. We kind of got hit by this 200-day EMA, and then of course the conference started, and Jerome Powell sounded as hawkish as ever, where he basically come out and said, look, just because we're looking to slower the pace of interest rate hikes doesn't mean that our final destination is going to be lower. In fact, we think the final destination is going to be higher than where we initially thought it would be back in September during their previous meeting. That sent the market tumbling because Jerome Powell's basically come out saying, look, we're going to probably be going slower for longer. And, the market did not like that. We had that 3.5% decline. We've broken this uptrend that we've been trading in since that October 13th low when we had that CPI reading. And, this chart just looks horrendous at this moment in time. Looking at the daily chart from a technical perspective, we've got that MACD line, which of course is still below that baseline 0, and we're about to form a death cross. So things just don't look pretty here. I think if we went and actually had a daily close below 10,700, that would indicate that we are going to probably go and break below the yearly low down at around 10,433. It's just not looking good at all. You could argue that we have technically still created a higher low, but who knows where this market is going to shut during today's trading session. The swing low just 1 hour ago before the markets opened was down at 10,678, which is only in percentage perspectives. If we just see down to that swing low that we've had for the whole year, or the yearly low, is only 2% away. So really, really volatile trading. And last thing before I end today's video is just pay your attention to the 10-year bond. I said during yesterday's video that I will only be looking at this graph, and if we break above this trend line, then it looks highly likely that we're going to go and hit 4.2 to 4.25%, or if we broke below this week's swing lows down at 3.9%, then we would likely go to the 50-day EMA, which currently sits at around 3.7%, and stocks would rally. And of course, we did have that initial move lower down to 3.97%, where we broke briefly below 4%, but ultimately the bulls come back in here for the bond market and sent it sky high. And I think earlier on during today's trading session, we did go up and hit 4.22%. So it's all about the bond yields. If we continue to trade higher here, then of course it's going to inflict more pain in the stock market. And whilst I'm there, I might as well just add a look at the dollar as well, guys. We're clearly in a wedge at this moment in time here for the dollar. It looks very likely that we kind of did actually earlier on during today's trading session go and hit 1.14. But if we break above this wedge, then I think we are destined to go higher. Here's the bottom side of that wedge. So if we break above here, then I think it sends us to 1.15 to maybe 1.16, 116 to 115. So all eyes on the dollar and the 10-year yield going into the next couple of weeks trading. And also, just before I forget, we have the jobs number tomorrow. Many investors should pay their attention to that due to the very strong jolts number we had earlier on this week that showed over 1 million job offerings. It's going to most likely tell us that tomorrow's job number is going to be a lot stronger than expected. And of course, we are currently trading in an environment where good news is bad news and bad news is good news. So if I am correct and this job number does come in stronger than expected, then you are likely to see this market potentially go and hit a brand new low. And the reason I say that is because if there's over 1 million jobs currently on offer within the US, then of course it's very hard to be unemployed. So I still believe we're going to have a very low unemployment number. And of course, that is one of the big pieces of data that Jerome Powell looks at, when choosing on how aggressive and when to stop interest rate hikes. So it looks to me highly likely that the Fed interest rate is going to go up to around 5 to 5.5%, and I don't think the market has priced that in. It priced in 4.5%. So I still feel like there's pain to come here for the Nasdaq 100, the S&P, and the Dow Jones 30, and it looks highly likely after yesterday's rejection that the lows this year are still not in.